Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, where we continually endeavor to help you master your wealth. Today, I'd like to highlight our third quarter market review and outlook report. In our second quarter report entitled The Fed versus the Consumer, we showed an image of two roosters, one representing the Federal Reserve and the other representing the average consumer, facing off in a battle for supremacy. With the Federal Reserve having increased short-term interest rates over 5% since May of last year, they've done their best to punish consumers and businesses by forcing higher borrowing rates on them in the hope that higher rates will lead to slowing demand for goods and services and thereby reduce inflation. The Fed also believes that meaningful job layoffs are necessary to slow inflationary wage growth and that their interest rate policy will ultimately lead to rising unemployment. However, despite the increase in interest rates, the U.S. consumer continues to be resilient, as shown by steady job and wage growth and declining claims for unemployment insurance, as employers still indicate more job openings than available workers. However, recent credit card data may be foreshadowing stress on consumers. Total credit card debt has now exceeded $1 trillion for the first time, and credit card losses by issuers are rising at the fastest rate since 2008. In addition, consumers, which make up about two-thirds of the economy, have used up a large portion of their pandemic stimulus money and are facing a resumption of student loan debt repayments beginning in October. While these factors are particularly painful for low-income consumers who roll over their monthly credit card balances, the overall picture for consumers is less worrisome. Credit card utilization as a percentage of spending has stayed steady, and those consumers who are homeowners have seen their home values appreciate markedly in the past year. Another positive for U.S. consumers is the fact that debt to disposable personal income is no higher than levels seen between 2015 and 2019. Regarding the stock and bond markets, we consider three factors to be most important, and these factors are inflation, interest rates, and earnings. Inflation data has improved dramatically since mid-2022, with headline CPI declining from 9% to a recent low of 3%. Despite a rise in the August headline CPI, core inflation, which removes volatile food and energy prices, dropped to the lowest level since September of 2021. We believe this trend will continue in 2024. Interest rates, a byproduct of Federal Reserve action and economic growth expectations, have risen over the past year as the Fed has steadily increased short-term rates in an attempt to slow the economy. Longer-term rates have risen due to better-than-expected economic growth. With the Fed signaling that they may be nearing an end to the rate hiking cycle, markets are now factoring in the possibility of a soft landing for the economy, which we believe is a very likely outcome. Working against this view is the possibility that the Fed may keep rates higher for longer, and by doing so, overly stress the economy. Lastly, over the past year, we maintained our position that corporate earnings were not going to be as bad as many feared. This was due to profit margins holding up as many companies passed on cost increases to consumers. Now that many input costs have started to decline, corporate earnings revisions have turned positive, and that has led to greater confidence in an earnings rebound in 2024. As we said in our previous report, the stock market's gains through the second quarter presented some near-term valuation headwinds for U.S. stocks, and we believe that the third quarter performance was likely going to be a bit choppy. This was indeed the case in the third quarter as large, mid-cap, and small-cap stocks declined in price. International stocks were also down in the quarter, hurt by a rising U.S. dollar. In addition, bond prices declined as well as interest rates rose. The third quarter was also challenged by an increase in oil and gasoline prices due to OPEC and Russian production cuts, tightening credit conditions at banks, political infighting over funding the government, and strikes by U.S. auto workers and Hollywood actors and screenwriters. Additionally, September is historically the worst month of the year for stock prices. However, in the fourth quarter and over the next year, stocks will likely outperform bonds as economic conditions are generally positive, employment data remains solid, core inflation continues to subside, the Federal Reserve stops raising interest rates, and the stock market anticipates an earnings recovery in 2024. Bond yields have become very attractive and do present a near-term challenge to stock valuations, but as investors begin to factor in a lower interest rate environment in 2024, we believe they will move assets out of money market funds, which have now reached an all-time high of $5.6 trillion. Thank you for watching today, and please read our full market review and outlook report for greater detail on the third quarter and our forecast for the rest of 2023. Take care, and we'll see you next time.